Hello, everyone. I am Fyruz Khan, and today I'm back with a brand new class. If you haven't still liked our Facebook page, you can always type in Fyruz Education Services and subscribe to our page because we conduct, we upload live videos, new videos every day, every week. We also have a great YouTube channel. You can subscribe to our YouTube channel. Again, just type in Fyruz Education Services, and we have, I think, around 60 videos. It's all synchronized. There's one playlist for Cambridge, for business studies, for edXL, for IELTS. So it's much more convenient and easy to find on YouTube. So you might want to refer to that as well. Um, so let's wait for some students to join and we can go ahead, start with the classes. Today we have a pretty interesting lesson for you. So let's start. So in a business, having a comprehensive income statement is quite important, quite pertinent. Because in a comprehensive income statement, what it shows is how much profit you've made, how much loss you've made. And previously in previous classes, we talked about different kinds of profit, different variances of profit. So you have gross profit, you have operating profit, you have net profit, and it all means different. And we will recap a little bit. For example, let's say your revenue, your turnover, money coming in. Let's say when you sell a good, when you sell a phone, you get revenue, turnover. When you get your revenue, when you get your turnover, and when you minus that with cost of sales, you get gross profit. Now you may ask me, what is cost of sales? For example, let's take a watch. This watch. This is my watch, and this is my favorite watch. So let's say you're making this watch, okay? The leather belt, the dial, the machines, these are cost of sales. Materials that are directly related to the production of the product is your cost of sales. Now, for example, at FES, our cost of sales is salaries of teachers. Okay, because because we teach, we are an education institution, so salary of teacher is directly related to our business. Now, let's say if we buy snacks, if we buy tissues, that is not our cost of sales because that is not directly related to our production. So if you make a watch, the dial, the machines inside, the belt is your cost of sales. And when you minus cost of sales, you get gross profit. Okay? And then from there on, from gross profit, you have your administrative expenses, you have selling expenses, you have other expenses, variable expenses, administration expenses, right? You may have to buy snacks, you may have to, you may have transport cost, you may buy tissues, you may buy other things for your business. And when you minus that, that is your operating profit. Okay, so when you minus your revenue with cost of sales, things that are related to the production of your goods, when you minus that, that is your gross profit. Okay, when you minus administration cost, variable cost, buying snacks, transporting your goods, transport cost, these are all when you minus that, that is your operating profit. Now, once you get your operating profit, now what happens in a business when you start a business or when you're expanding a business, you will take loans, right? And loans, the problem with loans comes with a certain interest. Interest is also an expense of the company. So when you minus, if you look here, when you minus your finance cost, say you've taken a loan of 1 crore, okay? Now there'll be an interest on top of 1 crore. Now that interest is a cost. When you minus that cost, you get net profit. It can be loan, it can be taxes to the government, right? Now, if you look at this chart again, when you minus your finance cost, you get net profit, and And then at the end you also pay tax to the government. That is also an expense. So you also have to deduct that. So after everything, the final profit that is left with you is called a net profit. Gross profit is only minus cost of sales, things that are directly related to your business or the production of goods. When you minus administration expense, that's your operating profit, the things that you need to run the company. When you minus your finance cost, that's your net profit. Because in a business, you will take loans. And when you take loans, there will be interest. In Bangladesh, the interest rate is high. In the Western countries, the interest rate is low. Keep that in mind. So when you minus that, you get net profit. And also keep in mind, at the end of the year, you need to pay taxes to the government. When you pay taxes to the government, that's quite important, and that's net profit. So we've talked about that. Just a recap of everything. So if you look at this statement again, uh, we have accounts for 2017, 2016, and if you have a look at the profit for the year in 2017 and 2016, you can differentiate. In 2017, they made a significant amount of profit, which is $40,000. In 2016, it's $14,000. So you can look at the differences. Gross profit was this. When you minus operating profit, it was this. When you minus finance costs, it was this. So every step you can see. When I'm looking at this account, the question comes to my mind: gross profit is 230, and then when I minus my operating expenses, it's 62. It's quite a jump. So that means I spend a lot in my operations, in my administration. So I can go and check what's going on. Why are we spending so much in administration? We need to look at that. It's quite a fall. And then when you minus that, if you look at the net profit after paying taxes, this is the latest figure. So the statement, profit and loss account, that statement is quite important because after every step, it shows your profit or losses that you've made: gross profit, operating profit, net profit, profit after tax, and it gives you a good idea. By looking at this statement, I could see that operating profit is a lot. It's quite a fall. There's a lot of expenses. That means the company is spending a lot. So you might want to go and check what's happening, right? Um, but there's also this other meaningful way to measure profit. Fine, I know what my profit is. I've made a profit of $40,000 or $14,000 in 2016. But how much profit? I want to know the size of the profit. Okay, I've sold this for $600, but how much am I making per unit? How much am I making per pound or per dollar or per taka? How much profit I'm making in every, let's say, 100 taka? That's also a very meaningful way, because what matters is the size of the profit margin. For example, let's say we have this book, the expense is, let's say, $10, and you sold it for $30. That's quite a margin, triple, right? But if the cost of making this book is $10, and if I sell it for $15, profit margin is low, it's small. So knowing the profit margin is quite important and essential, and we need to look at that. I think we have some messages here. I just want to check before I go forward. um okay, we are good. So yeah, let me check. Okay, so let's go ahead. So knowing the size of the profit is quite important. For example, um, I'm going to talk about something interesting. I know this is cheesy. So I, if you're familiar with this film, it was quite a rage. It was a discussion. It was a very popular film, a Bollywood popular film, Ashiki 2. And why I want to talk about this, because this is a fine example. I'm not a big fan of Bollywood movies, but I follow businesses in every field. So this film, it had newcomers, it had all new musicians, newcomers, everything. The expense of making this film was around 10 crores only. Okay, the expenses, but the revenue that they generated, revenue, I'm not talking about profit, the revenue that was they generated was 100 crores. Okay, so if you calculate the profit margin, it's 90 crores. It's a lot. I know the revenue is not so much, but then you always have to go back to the expenses. Okay, what is my expenses? So the profit margin is 90 crores. Let's talk about another movie. There was this movie in 2016 or 17 called Dilwale, and it had big stars like Shah Rukh Khan. And of course, when you have big stars, the revenue was 150 crores. It's a lot. Revenue means the money that they got by selling the tickets, more than Ashiki 2. But my question is, how much money did they spend on making the film? Because it's expensive. It has stars like Kajol and Varun Dhawan. So of course, this is an expensive film. They shot outdoor. They went to foreign locations abroad. So the cost of making that film was 120 crores. Okay, and the profit margin 30 crores. So yes, the revenue is more than um, this film Ashiki 2, but then that doesn't make it big. That doesn't make it big. You have to look at expenses, how much they have spent on their budget, how much they have spent on making the film. They spend 120 crores. That means the money that is left with them, the margin is so small, 30 crores. But if you compare it with Ashiki 2, it's 100 crores. So this is a smaller film. Probably they have more revenue, but that doesn't make it a bigger film. I have to know the profit margin, the expenses. So this is why sometimes your revenue, not sometimes, all the time, just knowing the revenue, knowing the turnover or sales is not enough. Fine, you made a revenue of $1 billion, but what is your expense? What is your profit margin per product? How much money are you making per £1 or $1 or 1 taka, right? Guys, if you have any questions, do not hesitate to comment down on the comment section. The class is going very well, and we shall be done soon. So, gross profit margin, gross profit margin. It shows the profit, how much profit you made on sales or turnover revenue. We've talked about that. The formula is here. Gross profit. You take the gross profit, divide by revenue into 100. So if we look at that comprehensive statement, take the gross profit, 230,000, divide by 561,000 into 100. That's it. So simple, right? So that will show your profit margin. So gross profit margin, how can you make, because making the higher gross profit margin you have, the better it is. So how can you have higher gross profit margin? You can increase the revenue, you can increase the turnover. Okay, you can increase the revenue, you can increase in that way. When you increase your cost, your revenue will increase. Okay, so keep that in mind. So you can increase the price of the product. But again, having said that, when you increase the price of the product, there may be people who may be demotivated to buy the product, because now the price of the product is more. Okay, so yeah, you can also cut down the cost of sales. You may cut down on your expenses. Okay, probably find cheaper suppliers, cheaper materials. But again, you have to be careful. This may impact on the quality. So you can raise the prices of your product, but when you raise your prices, people may be demotivated. People may buy your competitor's product or may not buy your product at all. They may move to a substitute product. Then you can also cut down your expenses, cost of sales. But when you cut down on your expenses, make sure that does not reflect on your quality. Okay, because when you cut down on your expenses, you look for cheap labor, cheap suppliers, and that may impact on the quality. And the kind of margin, the kind of profit margin you want to make based on products is also different. For example, let's have a look at this. Delicious. This is a Snickers bar. Snickers bar has been my favorite when I used to be a student. I always used to have 3-4 Snicker bars every day. I love it. I still love it. It takes back to my college days where sometimes I used to survive just eating Snickers bar. Now, Snickers bar is chocolate, of course. Now, Snickers bar is a bestseller chocolate, right? Since bestseller means you sell it often, it runs out quickly. You're selling it more. Now, if one Snicker bar costs 100 taka, um, let's say your estimated selling price is 200, but I think it's a lot. If you charge 200, it's a lot because it's a bestseller product. You're always selling it in a large quantity, so you can sell it for 140 taka. Okay, so your total expense is 100 taka. Your selling price is 140. The margin of profit is just 40. Why you're doing that? Because it's a bestseller, because you're selling it in a huge quantity. Okay, you also have to keep in mind something like Snickers bar is a luxurious product. Okay, we can also do without Snickers bar. It's not essential for us to live. It is not like rice, eggs, or milk, or oil, fuel. No. So if you take the prices up, a lot up, then people will not buy it. Okay. um so keep that in mind, okay. um but again, if you talk about the mic that I'm using, Rode NT-USB, now this is not a bestseller as in it does not sell so much. So let's say the total expense is 4,000 and the sync price is 10,000. The profit margin is around 2.5 times. Why are you charging it more? Because this does not sell often, so you want to make as much as profit you can. But in terms of Sneakers bar, the expenses is 100 and you're charging 140 taka. There's a profit margin of 40 taka only, and the profit margin is less. You can afford that because you're selling this in a huge quantity. Okay, so you have to keep in mind the profit margin differs from product to product. Okay, that's what I was trying to say. So the three things: you can increase your profit margin by raising the price, by decreasing cost of sales, by decreasing expenses. Okay, and I told you, understand the difference of product. If this is selling fast, make less gross profit margin. If this is selling low, the mic, then you need higher gross profit margin. If you have any questions, please do not hesitate to to comment down on the comment section. I'll take your questions. Okay. So gross profit margin. There's a worked example. The revenue, the profit, the gross profit is 230,000. Divide by total revenue is 561,000 into 100, so 41%. So on that product, you made a profit of 41%. It's so specific. It gives you an idea that, okay, by selling this phone or car, I made a profit of 41%. Okay, the expenses, let's say $1,300, I sold it for $2,000. It does not give you a clear picture, but here it's more clear. Okay, that's why knowing the margins is quite important. Now, operating profit, same. Okay, now if you want to know the operating profit, you take operating profit, divide by revenue into 100. Same. Here we took gross profit. Here you'll take operating profit, divide by revenue into 100. Same thing. You want to have a higher increasing operating margin is preferred. How much profit you're making on £1 or $1 or one taka, that tells you that. Okay, the formula is here: operating profit divided by revenue into 100. If you look at the table, operating profit was $62,200 divided by the total revenue is $561,000. This won't change, pounds actually. This won't change. This will remain the same. If you go back, you'll see this remains the same. Okay, so the first figure will change, and operating profit is 11%. Here you made 41%, and here 11%. It's a substantial drop. That means your expenses are much more higher in operating profit. So look out for that. Okay. And then net profit means you have to minus finance cost. The formula is simple: net profit divided by revenue into 100. Same thing, just the first thing will change, which is net profit here. Here you'll get operating profit, here gross profit, and then divide by revenue into 100. £40,000 divided by £561,000, which is 7.1%. And at the end, you can create a table that gross profit for 2001 was 41%. For 2016, 35.3%. So it's a jump. It's good. So why are you doing good? What has changed? Did the market change? Are you making better products? Or are your competitors, did your competitors become weak? Or have some of the competitors did not make good products? Or have some competitors have they left the market? What is happening? We don't know. Or have you spent a lot on marketing? Operating profit in 2017 it was 11%, in 2016 7%. Again, quite a jump. And profit for the year in 2017 was 7.1%, and here 2.8%. Again, it's a very good jump, almost double. So you've done quite well for 2017. So if you look at if you just look at the mayor statement, yes, it gives you an idea, but it's not so specific. This one is more specific. It tells you per product, per dollar, per pound, or per taka how much you've made. Okay, how much money you've made per £1 or $1 or one taka. So that's quite important. So per £1 you've made 41 pence or 41 cents or 41 paisa, right? Your operating profit margin for per £1 you've made 11 pence or cents or paisa. Same with profit for the year. Okay, I hope I was able to explain you clearly. Now, guys, if you have any questions, do not hesitate to comment down on the comment section. The classes are going great. Let me just turn on the AC for a bit. Now, there are ways to improve profitability. Now, let's say you look at this and you say, okay, for 2016, my objective is to make a gross profit margin of 50%, operating profit margin of 15%, and profit for the year 11%. You want to increase it. Now, how do you want to do that? There are ways to improve profitability, and we've talked about that. There are two simple ways. You can raise the price, lower the cost. Raise the price, lower the cost. Now, when you raise the price, of course, you will get more money. But when you increase, let's say you've increased the price of this product from $400 to $500, people may be demotivated. Yes, you will get money, but people may be like, I will buy some other product. I'm not going to buy this product because this is expensive. So there will be an effect in demand. So when price is raised, there can be a negative effect on your demand. So you want to look at that. Your competitors may react in different ways. You also have to look at your competitor's product. We are back to Sneakers Bar again. So the current selling price is 140 taka. Let's say you've decided to increase the price of Sneakers Bar because of pandemic. You've increased it to 180 taka. Now, since I told you this is not a necessary product, it's not a necessary product. It's a luxury product. I can even survive without this. So this is a price elastic good. That means demand will decrease when you increase the price, because this is not a necessary product. This is not something that I must need or I must require. I can do without this. And what will people do is they will substitute, they will go for other products. I will have, let's say, a Mars bar because that is the same price. So we have a substitute, and people will switch to the substitute. Okay, so think about that. So you really have to be careful. You have to understand the nature of your product. So for Sneakers Bar, you just cannot increase the price because it's a luxury product. Okay, and people may not buy it anymore. But if you think something like rice, here we have rice. I love rice, by the way. Now, if you think about rice, rice is a necessity good, a necessary good. We eat rice every day. I'm talking in terms of, in context of the Bangladeshi context. Let's say current selling price per kilo is 80. The government has decided to increase, let's say, 110 taka per kilo. It's price inelastic because it's a necessary good. It's a mass good. Everybody will buy it and eat it anyway if the price increases or decreases, or if the price increases or decreases. So there'll be a little change or no change in demand, because for rice, It's different. It's a necessary good. Another lagbe for rice, eggs, fuel, oil, coal, right? So these are essential goods. So whether you increase the price or decrease the price, the demand will remain the same. So think about that when you're increasing your price. Of course, increasing the price is a good way. Raising the price is a good way to increase profitability, but then think about the products. Okay. Right. The second way is to improve profitability is buy cheaper resources, buy cheaper suppliers. Think about new providers. Okay, I won't buy the camera from Samsung or Sony. Like Apple uses Sony camera, Sony lenses here, so we're not going to use that. Or probably we'll use Huawei or Xiaomi. It is going to be cheaper. But you can use cheaper labor. You can do that. But then think in terms of quality, right? Quality may damage, quality may come down, materials might be inferior, your image will be tarnished, you will have a bad image. So think about all of those, right? So so yeah, you can decrease, you can lower your costs. Lowering costs is always a good option. I'm not suggesting that you have to increase your cost. Look for ways how you can reduce the cost, but it must not impact your quality. Customers must not understand that, oh, they have reduced their quality in order to save some pennies. That shouldn't be visible to customers. You can cut costs cleverly and wisely, right? You can also use existing resources more efficiently. Think about, we can make companies efficient in many ways. Think about training your employees, training them to complete a task much more quicker. Train them. Okay. You can buy new machines, new models, new machines, new models can work faster, right? So think about buying new machines, or reducing waste, or just discovering new ways of working. Okay, so working efficiently, working productively, using your resources well, not wasting them, right? Training, buying new machines, all these things will make your company more efficient, more productive, and will save you a lot of money. Okay, because when you're thinking about industries, even if you save one penny, one paisa per product, that also helps, because in industries you're making millions of units. So one paisa or one penny or one pence per unit matters a lot. So we finished the chapter, which is great. So today we have spoken about gross profit margin, operating profit margin, and profit for the year. I've explained again everything. I've showed you examples, right? And then we talked about how to improve profitability. We touched a little bit on price elasticity, inelasticity. We talked about necessary goods, non necessary goods, non essential goods. So that's all. Do not hesitate to like our Facebook page. Just type in Fyruz Education Services. We have a 5-star rated page. And like our page, because we upload daily new videos, live videos. Please do not hesitate to subscribe to our YouTube channel. All the videos are synchronized and uploaded in a very systematic way on our YouTube page. Thank you very much. I will take your leave. It was a smooth class, it was a smooth ride. Thank you very much. I will be back tomorrow. Thank you.